joining us to kick us off today and to discuss those big investment trends that I mentioned, from TINA to now there's lots more alternatives, to China, to AI, and where all of this is going. Will we see the big R word? It's something that was on everyone's lips at the beginning of this year and seems to have faded, although the way I'm seeing it, I think the risk of recession is probably now bigger than it's ever been. We've got Anton Eser, who's the CIO of 10x Investments, recently returned to South Africa from the UK, and he was CIO of Legal and General Investment Management, was based in London, leading a team of 350 people across the regions and asset classes that played a key role in transforming the firm into a $1.3 trillion global asset manager. So warm round of applause, everyone, for Anton Eser. And joining Anton on stage is Chris Eddy, who's head of multi-asset funds at 10x Investments, the lead fund manager for 10x's multi-asset fund range. He's got a responsibility. He's also got a responsible outlook. I have him on the show all the time, but he's got a responsibility for asset allocation, for risk management, and for portfolio construction. And he's a CFA a charter holder as well. So a warm round of applause, everyone, for Chris Eddy. And just before we go into the various themes, this section going to keep very interactive. There are going to be Slido questions that we're going to bring up before each of the major themes, but we want you to keep your questions coming up on Slido as well. So while there are polls on Slido, we'd love you to participate in. We want to gauge the feeling and the mood and the attitudes of the room to these various big themes. Keep your questions going on there, and we'll see how many we can get through. Clearly, if there aren't any we can get through the session, we'll take those into the break. So we're going to take a look at the higher for longer kind of interest rate, inflation, debt dynamic debate. We're going to have a look at AI, and we're also going to have a look at China. I'm going to grab a seat here, and hopefully I'm not blocking anything. But Chris, kick us off with artificial intelligence, because at the start of this year, I mean, I was one of the, I like to think, early adopters of artificial intelligence using Sonics.ai years ago, but ChatGPT kind of changed everything. I think for a lot of people, the user interface now brought home the power of this technology. But I'm always very cynical, because you speak to a consultant about technology and they're going to sell you the next shiny thing. So how does this AI theme play itself out in markets from your perspective?
Yeah, that's right, Michael. I mean, the technology has actually been around for quite a long time. But I think really with ChatGPT, it brought it to the forefront, brought it to the headlines, it brought it into everyone's home, and really for a wider audience to experience that power. But I think what would be interesting is to get a temperature check from the audience first. You'll see the questions that we've got up on stage. US tech, or more primarily the Magnificent Seven, as they've become known now, has really been pretty much the only place to be invested in equity markets on a year-to-date basis. So looking forward, because I think as we talk through these themes, what's quite important is to contextualize how we think about investing. We always try to look at it through a longer-term lens. How are we going to build portfolios for the next 5 to 7 to 10 years to ultimately help our clients achieve their objective? And really, from a 10x perspective, that's always our viewpoint. How are we going to build portfolios for the longer term? So from your perspective, how do you feel about Magnificent Seven? Is tech going to be the only place for secular growth going forward over the next 5 to 10 years? Is it overvalued? Are we in another TMT type scenario? And it looks like pretty much 40 on the top side of the screen. You can see out of the 46 people who have voted, broad majority believe that tech is pretty much the only place to be invested, and it's going to continue outperforming broad market cap indices, which is quite an interesting observation.
Yeah.
So what we've got on the chart that we pulled up here is we've just looked at the largest companies in the globe by market cap over each of the different decades. Going back to 1990, it was Japan. Japan was going to take over the world. And you can see that 8 out of the 10 largest companies globally were Japanese companies. Fast forward 10 years, and with the event of the internet, well, the internet was going to change the world. And it did change the world. But at the time, the market thought, you know what, there's no other place to be invested. And there you can see 7 out of the top 10 were all TMT focused. Roll forward to 2010, coming out of the GFC, China was the global growth engine, and you can see that whether it be Chinese companies or companies in that broader commodity complex that benefited from Chinese growth dominated the largest. And you'll see there are 1 or 2 companies that are sort of consistently there, the likes of Microsoft. Apple was in the top 10 in 2010. But fast forward to the current environment, and you can see that it's all about tech and AI. The Magnificent Seven, that's Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, Tesla. You can see really dominating the current market capitalization. So if you're looking out over the next 5, 7 years through 2030, is looking back in history as well, do we think that this market leadership is going to continue to dominate over the longer term? And really looking back in history, it seems like that might be quite unlikely. What's quite interesting is if you looked at that 1990s, the 1990s domination, the 2010 domination, that was really ex-US, Japan and China. And then you look at sort of the 2000s TMT bubble, you look at currently the tech-driven AI rally, well, it's primarily US-centric. And you can see the impact that that has on broad indices like the S&P 500. The chart on the right-hand side here, you can see that looking at the weight of the largest 7 companies in the S&P 500 going back to the 90s. And what you can see is that the previous peak, pretty much at the top of the market in March 2000, at the peak of the TMT bubble, those 7 companies made up about 22% of the market. Interestingly, at sort of the market top in 2008, because it wasn't really a US-driven theme, concentration wasn't really that significant sort of at that market peak in 2008. But fast forward to where we are now, and you can see those 7, the Magnificent 7, make up just under 30% of the broader S&P 500. Now, the question you should be asking yourself isn't, is AI going to be revolutionary? I think the answer to that is pretty, as from your own personal experience, Michael, is that it has. There is significant amounts of efficiency that can be brought into everyone's working environment and productivity gains. But really the question is, are those productivity gains going to be greater than what the market is expecting? There's quite an interesting chart on the left-hand side again, just going back to look at history and this idea of like secular growth. And what we've got there is we've got the broad S&P 500 in the darker blue bars, and then we've got the 20 largest tech companies and Amazon, because Amazon was a smaller business, but that was really the one company that's flourished over the last 20 years. And we said, okay, well, at the peak of that tech bubble, what valuations were being applied? And we've done that as a revenue multiple, because I think revenue is really where, and revenue growth is really where a lot of the discussions have gone recently. And the broad S&P 500 was at about 2.5 times price sales. And that group of those tech companies were at 35 times price earnings. So like the revenue generation that was expected from the market at that point in time was really significant. Look over the next 10 years. That group of companies delivered significantly higher revenue than the broader market. Revenue growth was 7.7% year on year. Broader S&P 500 delivered 3.4%. So you're right, tech did change the world. It did deliver revenue growth. But the price performance, well, over that 10-year period, the S&P 500 was effectively flat. But that basket of those 20 shares were down almost 10% per annum year on year. So it tells you the price that you pay is really key in terms of seeing what's priced into these themes that are currently dominating markets.
I think that's fascinating, Chris, because I mean, ultimately, the room would very much consider themselves very bullish on tech, but given what you just articulated around the price that you pay, the likelihood of that bullishness outperforming over the next 10 years seems to be very unlikely. Given that, what do you see as the major risks for tech at the moment. And you know, you look at the concentration in the tech industry and the Magnificent Seven as they classified as. And often on the show we talk about the regulatory risk. And I think all over the world, and we saw it last year emerge quite strongly with Xi Jinping cracking down on tech companies in China. We see antitrust regulators in the US grappling with the size advantage that big tech has, and it tends to reward scale in a way that is very difficult to deal with in what are supposed to be competitive markets. Is there a real risk that regulators are going to start looking at the big tech companies and finding more innovative ways to try and break their market dominance? And do you see this as a potential big risk as well to tech in the future?
It certainly is a risk that has been flagged. The other side of that, which is not necessarily purely regulatory, which I think is quite interesting, is that if you look back over the last 10 years, that 40% of the earnings growth in the S&P 500 has been delivered through tax cuts. So in an environment where, and we'll unpack it a little bit further when we're talking about sort of the fiscal deficit and broader interest rates, is that, well, interest costs has been the focus in this higher interest environment as potentially impacting earnings. But you know what? You can fund a fiscal deficit from two ways, either by reducing your borrowing or by increasing the taxes that you're going to be charging. And it's going to be quite interesting to see how that environment evolves over the next couple of years as some of those Trump tax cuts start unwinding. So that for me is quite an interesting risk that isn't really being spoken about that often, because the tech businesses were the primary, together with healthcare and utilities, were the primary beneficiaries of those tax cuts in 2017, 2018.
Yeah, I think one issue.
The one thing I was going to add to that is, I mean, if you look at, let's say, Apple, which is market cap of $3 trillion, it's twice the size of the DAX, so the German stock market, in market cap terms. And there was an article I read the other day around some innovation which is coming in around potentially the replacement of the smartphone. I mean, that's ironically, it's actually the innovation that tech and AI will bring, which will disrupt the incumbents. I mean, that's what we've seen through, decades of innovation. It's ultimately, it's not about the theme. It's not about the AI and the tech. It's about actually the incumbents themselves eventually get disrupted.
Yeah.
And what are you paying for that, for the ownership of that company? And that's ultimately the big factor.
I mean, who in the audience has a BlackBerry apart from Mike Brown? I'm sure. Research in motion. Sorry, Mike.
Yeah, there we go.
No, but these really are quite fascinating themes. I was reading The Economist in the start of the year. Very bullish forecasts on the productivity gains that AI could potentially unleash. And I think that also fueled a lot of the bullishness that we're seeing. Given the economic challenges that we face, I mean, what are your thoughts on the potential benefits of AI and its diffuse application through society, and hopefully being, again, a bit of a headwind to rising inflation on the one hand, but also boosting productivity and creating efficiency gains on the other, as unleashing this next Gilded Age? Because that's what it felt like. A lot of the economists, bank economists, were saying this could potentially be another Gilded Age.
Yeah, I don't know. Maybe it's just I've been around for too long in these markets around the kind of the game changers that exist. I think if you look at how the internet has changed our lives, how smartphones have changed our lives, we've been going through this innovation for decades, and we can go back to the steam train. I mean, ultimately, we've had innovation for decades, centuries. But actually, if you look at, I mean, there's a long answer to this question. I'll keep it very short. If you look at the productivity gains we've seen over the last 20 years, it's actually been relatively low, right? So if you just take GDP and you take labor and capital and your residual is productivity, it's actually, actually productivity is going through a secular decline, not the other way. And so it's not, a lot of that productivity is not actually in more efficient utilization of capital and labor. It's around more, better quality of life, better interactions, better access to smart TVs, to social media. Is that productivity? But there's a long answer to that question, which I think we can answer right now. But I don't think it won't have the same degree of a structural change that is being anticipated, because we've lived through that for the last 25 years of the internet. And the same thing kind of applies going forward.
Right, I'm just looking at Slido quickly to see some questions coming through here from the audience. From Anonymous, please try and put your name before the question, unless you really want to remain anonymous, but we're all friends here. Chatham House, I'm not going to be reporting what you say on the show, or maybe I might, depends. Is this applicable to the dominance of US equity? 1990 Japan was approximately 30%. Is there possibility of a broader USA equity reversal? I don't know if you want to pick that up, Chris.
Yeah, well, I mean, certainly from our perspective, and we're looking to actually, I think, finish off this session trying to bring it all together from a sort of evaluation and a market outlook perspective where we'll touch on it. But the reality is, if we go back to how we think about investments over the longer term, price that you pay and valuations are important. Not only are US equities materially more expensive than they've been over the longer term, but on the other hand, you've also got these materially higher interest rates, which are kind of suck capital out of growth assets. There is an alternative, like you said in your intro. So the outlook is precarious from a valuation perspective, but what's quite interesting is off the back of this AI productivity-driven rally that we've seen, earnings expectations over the next 2 years, sort of 12% next year, 12% the year after that, aren't reflecting an environment, certainly aren't reflecting a potential recessionary environment, and aren't reflecting potential headwinds to earnings and to the sector over. So there's a disconnect. The market's expensive, and the outlook is relatively good from what the market is expecting over the next 2 years.
It reminds me of the NVIDIA results call in the last earnings period, and we're now entering the next one. But the CEO of NVIDIA said, we're having lots of conversations, 7x more conversations around AI and its potential applications. We're not seeing a 7x growth in order book and revenue growth. So people are talking about it. The expectation is there. It's not yet following through to the bottom line or even the top line. Let's actually now go and talk about interest rates and inflation and the debt dynamics that we see around the world, because that really, I think, concerns me quite a lot, Anton. If you just look at the fact that we've just recently had the USA downgraded by Fitch from AAA to AA. There's been this huge accumulation of debt through the global financial crisis and artificially low interest rates, and then the pandemic. And so the world is now precariously placed in a situation where we've seen this rapid rise in interest rates. How does this all come together?
Well, first, let's have a look at what the kind of consensus is in the room, which is very interesting. Once again, it's quite a strong consensus in that really we are going to, when we say back to the old normal state, interest rates are kind of 4 or 5%. Just so we're clear on that question. So it's basically saying that the current level is where we'll be, as opposed to going significantly lower, which is obviously where we were beforehand, or significantly higher. And I think the current view is that we are in the room, if I'm reading this right in terms of the answer, is that we will be going back to the old normal, the pre-financial crisis type of QE world, and we'll stay at this level. So that's really interesting. I'm going to try and answer why I think that's not possible. So just for full disclosure, I've worked in fixed income my whole career. So I'm a debt person and have followed debt markets my whole life. It sounds incredibly sad, but it's as it came out my mouth, it was rather sad. But I think these to me, and we fought about charts, didn't we? We kind of had to restrict it to a certain number of charts so that we didn't have a chart pack. So I had to be very selective in terms of which of the ones I wanted to put on. And I actually think I found the two most important ones. And on the left-hand side, we're just taking 10-year US Treasury yields back from the highs in 1980, around the inflation scale we had back then. And then on the right-hand side, we're just taking US debt to GDP. We could have taken, bunds, we could have taken global debt. It also tell the same story. But the correlation, obviously, between interest rates and debt is, as you would expect, it's a kind of a one-for-one. In the end, if you are able to raise money at a lower funding cost every single year, you're going to raise more debt because your cost of funding is just going to continue to shrink. So to me, the most if we're going to compete on themes, the most important theme is this. And that's led to a game changer across everything that we do, both from consumer debt, from government debt, and corporate debt. Post the financial crisis, we went through an unprecedented type of de-equitization of the system. Corporates issued massive amounts of debt and bought back equity, which led to kind of higher EPS and so on and so on. And we went through that for a good 10 years. It's just continued to kind of ratchet down, and that's continued to ratchet up. So we all know this story, right? But the important thing really is, now that we obviously are seeing this movement in interest rates, is how sustainable is this? And your answer from the consensus in the room was it's sustainable, that we can sit at a level of 3, 4, 5% in terms of funding rates, and actually maintain that level into the future. And the problem really is that, as you see on that left-hand chart, we're starting to see clearly the beginnings of the interest rate increases that we've seen in the last 18 months slowly start to filter across the system. It takes time. I mean, 30 to 35%, to take the US debt markets, around 35% of US debt in its entirety is floating rate. So as rates go up, then straight away it impacts your cost of funding. But there's still 2/3 of debt that's outstanding, which is fixed interest, fixed coupon paying debt. And take the US government as an example. I think the stats are, over the next 4 years, 50% of US debt has to refinance. And if you look at the numbers on that, the current coupon that the US government pays is 2.4%. The yield on Treasury bonds, the average yield right now is, 4.85%, let's say. So effectively, if you refinance, just taking your assumption that you had in the room, if you take that level, effectively the cost of funding for the US government doubles in the next 4 years. And just playing that through, just the pure maths of that playing that through, given that we saw in the previous chart that debt to GDP is over 100%, that means that the fiscal deficit doubles in terms of its interest costs. So currently it's a 2.4% drag on the fiscal deficit. 2.4% becomes 4.85%, and the overall fiscal deficit goes from 6 or 7 to 8 or 9 over the next 10 years. It's mathematically unsustainable. You simply can't run that type of deficit indefinitely, especially when your primary deficit is going up. And the same applies to Europe. Same applies. We're going to talk a little bit about China. China's even more difficult to make the numbers add up. But the reality is this will happen throughout the system. Corporates, investment grade, high yield. And as that happens, so what you see, as you would expect, is just tighter lending standards. And if you're a bank and you are lending to people through credit cards or whatever it is, and what do, right? Well, you do an assessment of the ability to pay that debt. And you do that assessment one day, and the interest rates are at 2%. And all of a sudden, 90% of everyone is applying for credit, you get credit. But interest rates are now at 7, 8, 9%. Credit cards are in the 20s. You look at that assessment and you go, well, no, I'm no longer going to approve funding for those individuals. It's just a simple tightening that banks will do. It's a credit cycle. And the reality is, just in working in this business for a long time, is economists are shocking at credit cycles. They do not understand the role of credit in the economy, how much it's had in terms of how much growth it's created on the way up, and the impact it has on growth on the way down. So we're somewhere in this process over here. Typically, it takes, in previous recessions, previous credit cycles, it takes something around 24 months from the tightening cycle to play out and lead to a significant reduction in credit across the system. But the reality is, and this is where timing is difficult, we can talk about the timing, but the reality is we're somewhere there, and every single credit cycle, every single tightening in credit standards we've had has led to a recession. The US goes in recession, the rest of the world goes into a recession. And the reality is, and just to finish off the point, is when that recession comes, yields start to come back down because treasuries at 10-year treasuries at 5% are super attractive in that type of scenario. And at some point, as the markets are under pressure and the S&P is starting to price in that different earnings expectation, then we're back to quantitative easing. So there is no mathematical way you can make the system add up without the central bank coming in and buying government bonds. Just mathematically doesn't add up. So I'll finish on that point.
So the Fed put's not going anywhere. Given that, I mean, it's such an interesting scenario, because if you look at that at a corporate level, it makes complete sense then that you'd want to avoid highly levered balance sheets and going into an environment that's potentially recessionary. But I want to stay with the fiscal situation for a while longer. I mean, you mentioned it, Chris, that no one's really talking much about the unfunded benefits in the US, and you've got the Trump tax cuts that are now being unwound, and potentially we might have a situation where because of this rising fiscal deficit, the US government's not going to have enough money to fund these benefits into the future without either cutting the benefits or raising taxes. Now, I don't know how you do that in a highly polarized political environment that the US finds itself in. So it's very, very difficult. But just to build on that a little bit more, Anton, how do you see the Fed responding? Because clearly they're looking at this as well, in an environment where inflation remains stickier for a little bit longer. We saw just yesterday really strong US retail sales numbers, and again, bond yields started to rise as a result. How does the Fed react if inflation does indeed stay well beyond its 2% target? Do you see it potentially budging on that and raising that target rate a little bit to try and ease the pressure?
I mean, they'll be in a bind, right? Because their inability to ultimately get that cost of funding down is ultimately going to lead to recession. So it goes back to the answer. The answer is almost impossible to give, because it is not possible for high inflation to remain in a recession. Okay, you can have stagflation, all right? But that's, in the scenario we're talking about here, it's very difficult to see how inflation stays at such a high level for a prolonged period of time. I mean, just take the most obvious example. Let's take oil prices. In the end, if you go into a recession, oil is going to be significantly lower. If it's significantly lower, that has a big impact on producer prices, ultimately filters through the system, and inflation starts to come down. So the only way you can have prolonged periods of inflation, like we saw in the 70s and 80s, is purely supply-driven. So it has to be geopolitical. It has to be an oil price at $120 and remaining at $120 because there is a massive supply shock to the system.
Strait of Hormuz gets shut now because of what's going on
Correct.
in the Middle East.
Yeah, but the demand side is typically the one which follows ultimately, in the end, demand, and that will lead ultimately to lower inflation and the Fed cutting rates. If that's a wrong conclusion, then you're at the situation whereby they're having to keep rates at 5%, and then you are into a proper credit cycle, because then there's a whole bunch of corporates who are now trading at a level whereby their earnings are kind of plummeting and their cost of funding is sitting up here, and then you're into a default cycle. And the default cycle, once again, will lead to the Fed, as it did with COVID, et cetera, stepping in and providing a support to the system.
And that kind of cascades down as well. What are your thoughts on this, Chris? And potentially, maybe a different slant to the question, if we are going into a recession, what shape? I recall a couple of years ago, everyone was saying we have a walk-shaped recession and not a V-shaped recession. I mean, do you have any thoughts on how long or protracted that could be?
Yeah, I think I think how everyone has been talking about it recently is hard landing, soft landing, no landing. It's kind of the words that have been put to it. But I think, sort of building on from what Anton was saying, a lot of the resiliency and the inflation pressure that we've seen has been demand side, because the US consumer has been a lot more robust than expected due to fiscal transfers over the last couple of years. So if that continues and you continue to see strong retail sales numbers, a strong US consumer, the probability is that the recession will end up having to be harder and deeper, because those interest rates will need to be remained at much higher levels to ultimately bring that under control. And the mechanism through which that happens is really unemployment and unemployment rate. And you see the US job market is still really tight. So the question, I think, is not if, but when that sort of Fed put ultimately comes in and low interest rates.
Well, I think the key thing goes back to that chart. The longer this continues, the more and more we lock into a higher cost of funding.
Yeah.
I mean, that's basically what happened in 2004 to 2007. Is, you know, we had ultimately a higher level of funding that was more locked in, be it mortgages or be it corporates. But the thing is that the longer this continues, this cycle, the more and more corporates are going to be funding at higher and higher levels and have to refinance at higher levels, and that's refinance that's happened, you know, for a period of time.
Yeah, that cost of capital is going to be hugely negative for earnings into the future, one would imagine then. Another question from Anonymous around modern monetary theory, MMT. I was hoping that MMT adherents had finally learned their lesson through what we've experienced around printing money causing inflation, but he reckons or would like to know whether or not it's keeping the recession at bay for those countries that can print their own money, like the US, I'd imagine, or will the budget deficits eventually catch up?
No, I think it won't keep it at bay, but it will be the response. You know, I don't think you have to. I mean, it's just an extrapolation of what we've done. I mean, it's an extrapolation of the last 40 years, but in particular the last 15 years, right? We saw it in Japan. It's very much a kind of a central bank thesis which they will subscribe to, and it's because it's the only response. I mean, and ultimately funding the government and manipulating the cost of capital is what a central bank believes its mandate is. But they will only do that once, you know, we've got stock market significantly lower, once we're in a recession, and once they move the Fed funds rate significantly lower. But MMT will absolutely be.
What's quite interesting is you've seen a bit of pushback against that over the last 12 months from the market. If you look at what happened in the UK last year, and more recently in the last 3 months, the sort of return of the term premium to the back end of the US curve, the US interest rates going materially higher, not at the short end, which is driven by monetary policy, but at the long end as this sort of pushback around sort of fiscal discipline from governments is starting to worry market participants.
Yeah, back to Ray Dalio. I mean, he just said you're not being sufficiently covered for the risk that you're taking on the term premium on the US 30-year at the moment, given the fiscal situation that the US finds itself in.
But that view is fundamentally flawed, because if the central bank can come in and buy as much 30-year Treasury bonds as they want to, then, I mean, the term premium is irrelevant because they set the price. They did it post the Second World War. The Japanese have been doing it now for the last 10. I mean, that's ultimately
with
what
yield
central
curve
banks.
Control? Yeah.
They can't have a 30-year at 6%, 7%, 8% prolonged period of time. So the central bank will come in and buy it. So, you know, he's right, but he's wrong. Sorry to call Ray Dalio wrong, but I mean, he's, you know, absolutely. I mean, it's they can print money, and they can buy what they want to buy. The only thing which again gets in their way is significant levels of inflation.
Loving the conversation. The questions coming through are, how do we position for this environment? We'll get there. But first, China. This was supposed to be China's year, wasn't it? I mean, we started the year with everyone saying, oh, China's finally coming out of the hard lockdown. They remained locked down for longer than any other advanced economy. They're not a middle income. I mean, they really are. They're a second largest economy on earth. And yet we didn't see China come roaring back. We just saw a big property crisis. So what's happening in China? Is it uninvestable?
Well, it looks like that according to the initial voting. So let's see. Maybe we'll get a few more coming through. But yeah, I mean,
nobody call Michael Power and tell him this.
I think there's a lot of sort of bifurcated views around this. Some people feel really strongly that China's uninvestable, and then on the other side of the coin, you know what? There's a valuation argument to those assets that exist. So it seems like the middle of the road looks like the option that is being favoured by most of our audience today. Building on from that debt theme, I think what we've pulled up here is just looking at sort of the evolution of the total debt in the Chinese economy, and over the last 30 years, that's gone from about 100% of debt to GDP to over 350% of debt to GDP now. So you can see there's been this massive explosion of debt. Now, the one big trend in the Chinese economy that's kind of mirrored this is the move of urbanization. Kind of at that time, you had about 25% of the Chinese population living in cities. That's now gone to about 65% over the last 30 years. And for a sort of comparative, The US is sitting at about 75%. So you can say that sort of urbanization push has really primarily been completed. And what's come with that is that for many years there was a real legitimate demand for residential property housing. And this urbanization push really created this sort of pro-cyclical cycle where you had demand for property, which led to higher property prices, which led to developers looking to develop property, but they had to fund that with debt. So they funded the development with debt. And then there was more demand, so prices went up higher. So property developers developed more sites and borrowed more. And the cycle just continually fed on itself and fueling, leading to this explosion of debt, primarily concentrated actually in residential property. And this is, I think, a crisis that and concern that is well known to everyone. But really, the big change was when the Chinese government came in sort of 2020 with their 3 red lines policy and said, you know what, this debt is actually unsustainable. We aren't comfortable with the level of debt accumulation here. And they really implemented some policies to try stem that property cycle and to ensure that the developers weren't taking on even more excessive amounts of debt. But the problem with that is that it pulled the oxygen out of that cycle. So because there wasn't any more debt to fuel that, property developers now were not able to even complete projects that had been paid for by consumers. Property prices weren't necessarily going up. It meant that individuals weren't necessarily wanting to buy a second or a third property. And the reality is that property and the size and impact of property in the Chinese economy and the role that it's played over the last sort of 25 to 30 years means that that property sector makes up about 25% of the total gross domestic product in China. And if you think about China, China makes up about 1/5 of global GDP. Now, just going back to sort of residential property as an asset class in China, you had all this leverage, but the Chinese economy, their capital controls, the money can't really go anywhere. So it ultimately fed on residential property. And actually, looking at all asset classes around the world, Chinese residential property is probably the largest asset class. Numbers that we've got from Goldman Sachs is about $62 trillion worth. And what's quite interesting is if you also compare the composition of Chinese wealth to that of other economies, you can see that there's a massive outsized wealth effect that resides in residential property. Whereas if you look at the US or Japan to other large economies, wealth effects is much more sort of situated in equities and fixed income. So I think just to kind of finish this off, the concern from the Chinese perspective is that property valuation became so expensive at like 40 times cost to income. What does that mean? Well, it means that you'll have to work for 40 years to afford a property. For comparative purposes in the US, it's about 10 times. So you can really see the extent of this overvaluation in these sectors. And as that oxygen's being pulled out and the Chinese government is trying to slowly manage this move from a investment-led economy to more of a consumption-based economy, the pain that comes with that is really significant.
And especially given what you just said about the concentration of Chinese household wealth in their home, in their residential property sector, because this must clearly have a huge negative knock-on effect on consumer confidence in China. And I think that's one thing that many commentators were grappling with, is that they expected the Chinese consumer to come out and be able to spend again after being locked down. We just haven't seen that.
Yeah, no, that's right. And what's quite interesting is there's this, when Chinese government basically cut off debt to these property developers from banks, they moved their primary financing to this forward sale model, where basically they would sell a property to an end client. They wouldn't have built it yet, and they would take that money and go start building property for clients that had sold properties to 2 or 3 or 4 cycles ago. So really what's happened is that people have paid upfront for property that's never really been delivered. And it actually led to a bit of a mortgage strike where people were refusing to actually pay their financing because they weren't being delivered houses. And if you think about that, that is a massive knock on consumer confidence. And the wealth effect that's really important in driving consumer confidence, if all your wealth is situated in residential property, there really are concerns, and you're seeing that, is that everyone expected coming out of this COVID lockdown that China was going to be the driver of global growth, as many other economies experienced, but it just never eventuated.
Yeah, much to the chagrin of our commodity complex, which has been reflected in their underperformance this year. Coming back to what levers are available, I don't know, maybe if you've got a view on this as well, Anton, for the Chinese government to manage this, to ensure it's a bit more of a soft landing. And I think some market commentators have been quite surprised that we haven't seen as much stimulus potentially from China as they had hoped. How does China manage its way through this predicament?
I mean, it has to be fiscal. That's the biggest tool they have, fiscal, and just to Chris's point around the tightening of what's happened in the property market. So it has to be a combination of fiscal and regulatory change in property. They have to support the property market. They have to bail out the developers who we know about, and they have to provide fiscal stimulus, and they have to provide kind of regulatory forbearance for a lot of the property. That's the monetary tool is a lot less impactful in China. Interest rates are relatively low, and consumer debt is not massive. Man, that is a positive, but so it has to be fiscal and it has to be property focused.
Yeah,
but I think we're a long way. We are a long way from that.
They do save, the Chinese consumers. They are a nation, not like us here, who like to buy the next shiny thing. So we've got 10 minutes left. I think tying this all together, then the big question is, how do you see this playing out then, and how do you position portfolios given these three major themes that you've just articulated? I don't know who wants to kick off on this. Chris?
Sure, I'll start, and I'll come back again just to re-emphasize how we think about investing. These long-term themes are definitely going to impact markets out over the next 5 to 7 years. But for us, that starting point is, well, what is the market expecting those outcomes to be? And is that assumption reasonable or not? That ultimately leads you back to valuations. So what we've got on the chart here is we've got kind of a measure of how cheap or expensive equity risk is in the US. It's equity risk premium chart, and what we've basically done is we've taken the CAPE earnings yield, so the cyclically adjusted PE ratio, and sort of inverted that. It gives you really a real yield on US equities, and we've compared that to the real yield of a 10-year US inflation bond. And what you can see is currently, as at the 30th of September, that real yield on US equities was at 3.6%. Going back to 2000, that compares to an average of 4.8%. So equities in their own right, not relative to bonds, but in their own right, are sitting at about the 14th percentile. So that yield is kind of in the really lower end of the range, which means that markets are really relatively expensive. You then look at bonds as a standalone asset class. Well, the long-term real yield on US 10-year government bonds over the last sort of 23 years has been about 1.1%. You're now getting paid, well, as of yesterday, it was actually about 2.4%, given the continued sell-off in yields that we've seen, which is really sitting at above that 80th percentile. So equities outright are expensive. Bonds outright are materially cheaper than they've been in a long time. And you put the two together on a relative basis, well, that risk premium is really sitting at about the 8th percentile, really at the lower end of the range over the last, call it 23 years. So simplistically, what does that mean? Well, it means valuations favor bonds and not equities, regardless of what the next 5 or 7 years may hold. Then you kind of overlay potentially an outlook of a potential recession, building on everything that Anton's spoken about in terms of the tightening credit cycle. Well, if you have a deteriorating outlook to earnings growth, which we mentioned is actually relatively robust over the next 2 years, that picture changes even more significantly. Yeah, do you want to just pop up the last chart, and then we'll just finish up. So this is
kind of a nice takeaway in terms of understanding, if ultimately we are going in a recession in the next 12 to 24 months, what do you buy? What do you own? Obviously, we know bonds is a good investment. But one interesting thing there on the right hand side is the dividend aristocrats, which is an index which is constructed, which is skewed towards high quality dividend paying corporates who've consistently paid dividends over the last 20, 30, 40 years. And just full disclosure, we in our portfolio, we've allocated a fairly decent chunk of our global equity to these companies. And then we were reading the research report here by Rosenberg, who pulled this up, and there it was. So it wasn't, I promise you, it wasn't a skew beforehand. But I think it kind of says to you that you can see that you can still hold equities, most certainly, and we definitely are long-term investors. But actually, from a risk-return perspective, skewing that portfolio to high-quality equities in the portfolio is a very good way to still be invested in equity markets, but be invested in quality companies. Chris mentioned bonds versus equities is obviously a good position for us. And I think it kind of talks to the point, just back to the theme of the conference, and we talk about and think about index investing. Index investing is not just market cap based in investing. It is most certainly at times when you want to, just to the first slide we pulled up around that skew of the top 7, that's actually about risk management.
Yeah.
If 30% of your US equity portfolio, which is 21% of your total global equity portfolio, is invested in 7 companies at these valuations, from a risk perspective, that is not a good way to allocate your risk. So when we think about constructing portfolios, it's valuations, but it's risk management. And index tools like allocating to a strategy like that enable better risk management. So our portfolio, obviously we invested, 65% of the portfolio is still invested in equities, but within that we're able to actually skew it to bring more and better risk management into the portfolio through allocations like that.
I find that so interesting. It's about risk-adjusted returns, but more than that, through this part of the cycle, everyone was saying, no, you can't go passive in inverted commas. Now, we know it's not passive. Every decision in using these building blocks is an active decision, but it's going to be more of a stock picker's market, for example. But I think what you're clearly demonstrating here is that you can use an indexing lens and approach and the right building blocks to build something that's really robust for this time. Chris?
Yeah, I mean, that's certainly the way that we approach it. Stock picking isn't part of our value proposition or our skill set. Some people can do that, and there can be some value added through that. But just building on what Valdine said, the number of different indices that are available talk to all the different tools that are really in an allocator's toolbox now to really express pretty much any view that you that you have. And certainly building defensive equity exposures is one approach that one could take.
Fascinating. Guys, warm round of applause. Thank you very much. Thank you very much, everybody.
Thank
Chris
you.
Rawl, Anton Eser.